Oil prices eased as scant details on the first phase of a trade deal between the U.S. and China undercut last week's optimism of a USChina thaw that helped lift crude markets by 2% at the end of last week. The emergence of a phase one trade deal between the U.S. and China and a goodwill move by Washington to suspend threatened tariffs on Chinese products had initially lifted global financial markets on Monday. But investors remained cautious given that few details emerged from those talks. And of course, research analyst FXTM Lukman Otunuga joins me in the studio to discuss this and more. Lukman, it's good to have you finally in the flesh.
Thank you for having me. It's a pleasure.
It's good to have you. Now, let's take a look at commodities. Any hope for oil prices to rebound at this rate?
Yes, we've seen the dynamics of oil markets toggle from supply side to demand side. But right now, the major factors moving oil is demand side dynamics. So concerns over the health of the global economy, especially when we have major institutions like the IMF downgrading their growth forecast to 3.2%, the World Bank expressing concerns of the global economy, the Organization of Economic Development saying world growth could be 2.9%. So as long as there are concerns over the slowing global economy, impacting demand for crude, any upside we see in oil prices should be limited, and this is exactly what we're seeing today.
And talking about the impact itself, countries like Nigeria, who depend largely, for foreign exchange from the oil sale, as it were. So, what do you reckon, especially coming down to our benchmark crude, as it were?
Yeah. So, as we know, that 90% of Nigeria's foreign exchange earnings is from oil, and this accounts to 70% of government earnings as well, government spending, so it's quite significant. Now, speaking of earnings, when we're looking at the 2020 budget, it's already predicted that oil prices is going to be around $57 for 2020. I see where this is coming from, but the fact that demand side dynamics are influencing where oil is going to trade, it's quite optimistic. So yes, we're going to have geopolitical risks, like we saw the events that happened last week with Iran and Saudi Arabia, which may fuel concerns of negative supply side shocks. But for as long as demand remains missing for the equation, oil prices, it will be difficult for oil prices to trade back above $60 in 2020.
Yeah, of course, the volatility continues, as it were. Very good. Now, talking about the U.S. Federal Reserve, will they cut interest rates 2 more times in 2019, you think?
Yeah, so this is a very interesting question I've been looking at, and it depends the way you take it. Is the Fed data dependent, Trump dependent, or trade dependent? When we look at economic data from the United States, it's been mixed, but really it doesn't really warrant a rate cut. So I think the major driver that's forcing the Federal Reserve to ease monetary policy is just concerns over the negative impact of trade tensions. And we can already see in the United States, if you look at manufacturing activity, it's slow to its slowest rate in 10 years, and this is trickled to services, which has seen its slowest growth in 3 years. So for as long as trade uncertainty remains a major theme, the Federal Reserve is going to cut interest rates in October, and there is a possibility of another rate cut before the end of 2019.
Yeah, we all also witness President Trump's pressure on the Federal Reserve every now and then, So let's take a look at, where do you see the dollar in all of this?
So at the start of the year, I must confess I was bearish on the dollar, but things are changing right now. So naturally, as we know, lower interest rates will reduce the interest rate differentials between the dollar and other major currencies, naturally weakening the dollar. But at the same time, the dollar is still considered as a safe haven currency. When you look at the health of the United States, when you compare it to Europe, which, especially Germany, which experienced a contraction in the second quarter at 0.1%. If we look at the United Kingdom, we also saw a contraction of minus 0.2% in the second quarter. So in general, when you compare the US to everyone else, the US is still the best place to be. So when there's uncertainty, investors are likely to rush towards the dollar, which is still seen as a prime destination of safety. So my outlook for the dollar is actually mixed. It's mixed in the sense that safe haven flows could boost appetite for the dollar. However, lower interest rates in the United States will reduce appetite. Looking at the dollar index, I see the dollar index ending the year around 100.
Wow, interesting development there. Now let's take a look at the outcome of the US-China trade talks last week. What does this mean for the global economy, in the coming weeks?
Yeah, so we saw collective self-relief across financial markets. These trade...
Cautious relief, to be precise.
Cautious relief. These trade talks have been going on for 18 months, and after the 13th talk, here we are right now. So if we look deeper into what was agreed, it's not considered as a major breakthrough,
Okay.
but it's a right step, and it shows that there is some light at the end of a long trade war tunnel. So China has agreed to boost its purchase of US agricultural goods, and the tariffs that were going to be hiked on October the 15th are going to be delayed. The 5% hike on the 250 billion on Chinese goods. So naturally, this is going to ease tensions, and easing tensions will support risk sentiment. This is why today we're seeing global equity markets pushing higher, while safe haven investments like the Japanese yen and gold are lower. But I still think it's too early to relax, because this is not the first time we've seen things go in the right direction, only for everything to fall apart like a tower of Jenga blocks down the line. So until we see things on paper, that's when it's time to celebrate.
Indeed, you also talked about the global economy, but what about emerging markets, with this scenario in place?
This is a welcome development for emerging markets for many, many reasons. So when we speak about emerging market energy producers like Nigeria, a positive outcome to US-China trade developments, economy, which will naturally support appetite for oil.
Yeah.
It's good. At the same time, the improvement in risk sentiment should boost appetite for emerging market assets.
All right, I know we talked about this earlier, just as you came into the studio. Still on Nigeria, so what's your thought on the budget by the president?
It was an interesting, very optimistic budget, and it does have the potential to elevate the Nigerian economy. But according to the International Monetary Fund, the government revenue targets were overly optimistic. Now, when we look at the figures, so we have a massive expenditure of 10.3 trillion naira, and government revenues are 8.155 trillion. And so this leaves us in a deficit of 2.18 trillion. So naturally, to plug the hole in the deficit, Nigeria will need to borrow. But then when we're looking at government expenditure, I just want us to focus on oil. So, Nigeria's targeting oil at $57, at 2.18 million barrels a day, at exchange rate at $360. So let's look at things domestically and externally.
All right.
So domestically, the last time Nigeria was able to pump over 2 million barrels a day, according to the Organization of Exporters, was back in 2013.
All right.
In August, Nigeria's production was around 1.84 million barrels a day. And OPEC, Nigeria has already pledged to OPEC that they're going to cap their production around 1.77. So it'll be interesting to see how Nigeria is able to actually pump 2.18 million barrels a day in 2020.
Indeed.
And going back to oil prices, we've spoken about it earlier. 57 is quite ambitious given how there's still uncertainty over the global economy. And for as long as I keep saying demand is away from the equation, it will be very difficult for oil prices to trade around 57, 58. So just based on these themes alone, it will be very interesting to see if the budget is able to fulfill its goals. And lastly, if we look at 2019, there was repeated delays in that budget. So I think the first step would be for the budget to be passed before the end of the year.
All right, just a one-off question here. Now, analysts have described the budget as being timid and probably not reflective of the current realities, some which you've also raised, as it were. So what are your thoughts there?
As I said, timid is a very, very strong word, because we're seeing that there is optimism. The budget does have the potential to elevate Nigeria in a perfect world. But then when we have so much domestic and external factors that could get in the way, it could impact the effectiveness of the budget.
Very good. Now, let's take a look at the outlook for, or your expectations rather, on Nigeria's inflation figures and how it will impact CBN's monetary policies. Yes, we're still expecting the main figures, as it were, but what are your thoughts over time up to this moment?
I mean, it's been good. The previous inflation figures, it was 11.02 in August, the lowest seen in over 3 years. So there is repeated signs of easing inflationary pressures in Nigeria. Now, signs of easing inflation pressures is good for consumers, you know, and that's something that will help Nigeria's economic growth, given how consumption accounts for 80% of GDP. Now, focusing on the CBN, I'm still 50-50 if they would join the global easing train. The reason I'm saying this is because the CBN governor has said that for the central bank to cut interest rates, inflation needs to moderate back to 9%.
Wow. And there's also been talks about this single-digit issue, as it were. So what do you make of that? Can that be achievable in the short term?
Not in the short term. And the reason I'm saying this is because, number one, we know that going back to the 2020 budget, you know, one bright spot is VAT is going to be increased from 5% to 7.5%. It's a right step given how Nigeria has the lowest VAT in sub-Saharan Africa. But the implementation of the minimum wage, when it's implemented, it's not in play now from 18K to 30K. These two things are going to revive inflationary pressures in Nigeria. And given how the government has already predicted inflation for 2020 to hit around 10.68%, the Central Bank of Nigeria could be forced to sit on its hands. The only way the CBN joins or eases policy is if it's pressured by, you know, other central banks across the globe. Cutting rates.
All right, very good. But briefly, I just still want your thoughts on this, the economy for 2019, your outlook for it. What do you make of it, in accordance with all the scenarios you've just painted for us?
Overall, I'm still cautiously optimistic over Nigeria's economy. I've been since the start of the year. As I said, you know, you can't compare Nigeria's economy to developed economies. You know, developed economies, especially the UK, they've experienced a contraction in the second quarter, while Nigeria still was able to squeeze out growth around 1.94%. I believe Nigeria's outlook will continue to will be influenced by external drivers. Now, these external drivers would be US-China trade developments. The reason I'm saying this is because, you know, total trade with the United States in 2018 was around 9 billion, over 9 billion, and total trade with China was over 10 billion. So naturally, as I keep saying, when two elephants fight, the grass will get hurt. At the same time, Brexit will impact Nigeria because, you know, if you look at trade deals between the United States and Nigeria, the middleman is the EU. So if the UK does have a hard Brexit, this could impact trade.
On that note, I'd like to thank you, Lukman Otunuga, Senior Researcher, Analyst, FXTM. It's good to have you with us.
Thank you. It's always a pleasure.
All right.